What if I told you that starting late might actually be your biggest advantage? Most people believe that if they didn't start investing in their 20s, they've already lost the game. They look at stories of tech millionaires, early crypto investors, or people who bought houses in 2012 and think, I missed my chance. But here's the truth. Wealth is not built by age. It's built by strategy, consistency, and leverage. And if you're starting in your 30s, 40s, or even 50s, you're not behind. In fact, you may be more focused, more disciplined, and more intentional than ever before. Today, we're breaking down exactly how to build real, lasting wealth, even if you feel like you're starting late. First, you need to destroy the too late mindset. This belief is more dangerous than any market crash. Starting late usually means you've lived enough life to understand risk, responsibility, and priorities. You're not guessing anymore. You likely have clearer goals. Maybe you want financial freedom. Maybe you want to retire comfortably. Maybe you just want peace of mind. That clarity is powerful. Younger investors often chase trends. Late starters can focus on strategy, and strategy beats hype every single time. The second step is increasing your income aggressively. If you're starting late, time is shorter, so income matters more. You cannot rely only on slow growth. You need to widen the gap between what you earn and what you spend. That might mean asking for a raise, switching companies, learning a higher-paying skill, starting a side hustle, or monetizing something you already know. Wealth acceleration begins with cash flow. Investments grow money, but income creates the fuel. The faster you increase income, the faster you can invest. Next, control your expenses without shrinking your life. Many people think building wealth means living miserably. That's not true. The goal is intentional spending, not deprivation. Audit your expenses, cut subscriptions you don't use, negotiate bills, avoid lifestyle inflation when income increases, but still enjoy life, just spend on what truly matters. Wealth grows in the gap between income and expenses. That gap is your power zone. Now let's talk about high-impact investing. If you're starting late, you don't need complicated strategies. You need proven systems. Focus on diversified index funds, retirement accounts like 401ks and IRAs, and tax-efficient investing. Consistency beats complexity. Automate your investments. Treat investing like a bill you must pay every month. Even if you start with smaller amounts, the habit matters. Compound growth may have less time to work, but when paired with higher contributions, it can still produce powerful results. Another powerful wealth-building tool for late starters is leverage. Leverage doesn't just mean debt. It means using systems, assets, and other people's skills to multiply your effort. Real estate, businesses, digital assets, or partnerships can all be forms of leverage. When used wisely, leverage accelerates wealth far beyond simple saving. But it must be strategic, not emotional. Never chase leverage without understanding risk. Debt management is also critical. If you're carrying high-interest debt, especially credit card debt, that is your first enemy. A 20% interest rate works against you faster than most investments can work for you. Prioritize eliminating high-interest debt while still contributing enough to capture employer retirement matches. That balance keeps you moving forward while cleaning up the past. Finally, build financial resilience. Starting late means you can't afford major setbacks. Create a solid emergency fund, ideally 3 to 6 months of essential expenses. Get proper insurance coverage. Protect your income. Wealth isn't just about growing money, it's about protecting what you build. Stability allows you to take calculated risks without fear. Building wealth later in life isn't about catching up to someone else's timeline. It's about maximizing your own. You don't need 40 years if you build with intensity, clarity, and discipline. The game isn't over. In many ways, it's just beginning, and this time you're playing smarter. Now let's talk about something most late starters overlook: time compression. When you start early, you rely heavily on time to grow your wealth. When you start late, you rely on intensity. That means higher savings rates, smarter investment decisions, and eliminating distractions. Instead of saving 10% of your income, aim for 20%, 30%, or even 40% if possible. That might sound extreme, but remember, this isn't forever. It's a focused season. A few intense years of disciplined wealth building can dramatically change the rest of your life. One powerful strategy is front-loading your investments. The earlier you invest larger amounts, the more compounding you allow within your shorter timeline. If you receive bonuses, tax refunds, or extra income, resist the urge to upgrade your lifestyle. Instead, deploy that capital into investments immediately. Think of every extra dollar as a future employee working for you 24/7. Wealth grows when your money works harder than you do. Another critical move is maximizing tax advantages. Many people starting late underestimate how much taxes slow down wealth building. Contribute aggressively to retirement accounts like a 401k, traditional IRA, or Roth IRA, depending on your income level and situation. Take full advantage of employer matches. That's an instant 100% return on part of your money. If you're over 50, use catch-up contributions. The government literally allows you to invest more because you're closer to retirement. Use that opportunity fully. Let's shift to asset selection. If you're building wealth later, you need a balanced mix of growth and stability. A portfolio heavily weighted in diversified index funds can give you exposure to the stock market's long-term growth while minimizing individual company risk. Some exposure to bonds or fixed income investments can reduce volatility as you approach retirement. The goal isn't to get rich overnight. It's to grow steadily while protecting downside risk. Now here's where many late starters make a mistake, trying to make up for lost time with high-risk bets. Chasing penny stocks, day trading aggressively, or going all in on speculative assets can destroy years of disciplined saving. Risk should be calculated, not desperate. You don't need a miracle, you need a repeatable system. Wealth is rarely built in one big move. It's built through consistent execution. Let's also talk about career capital. If you're starting late, your greatest asset is likely your experience. Instead of just working for income, think about how to turn your expertise into higher value opportunities. Can you consult? Can you negotiate better pay based on performance? Can you move into leadership roles? Income growth combined with disciplined investing creates exponential impact. The more valuable your skills, the faster wealth compounds. Another overlooked area is geographic arbitrage and cost optimization. Some people dramatically accelerate wealth by lowering their living expenses without lowering their income, moving to lower-cost areas, refinancing mortgages at better rates, downsizing strategically, or reducing unnecessary liabilities. When fixed expenses drop, your savings rate skyrockets without increasing effort. And don't underestimate the psychological side. Starting late can come with regret. You might compare yourself to peers who invested earlier, but comparison is poison to progress. Focus forward. Wealth doesn't care about your past. It responds only to your current actions. Discipline today matters more than missed opportunities yesterday. Finally, define your finish line. Wealth building isn't just about a number in a bank account. It's about freedom, the freedom to choose your work, your schedule, your priorities. Calculate what financial independence means for you. Estimate annual expenses. Multiply by a sustainable withdrawal rate. Set a clear target. When the goal is defined, the path becomes measurable.
Starting late doesn't mean starting weak, it means starting aware. With focus, higher savings rates, tax efficiency, disciplined investing, and income growth, you can build meaningful wealth in 10 to 20 years, sometimes even less. The key is urgency without panic, strategy without emotion, consistency without excuses. And when you commit fully, you'll realize something powerful. You weren't late, you were just getting ready.
Now let's go deeper into acceleration. If you're starting late, you don't just need growth, you need momentum. And momentum comes from stacking strategies, not relying on one single path. Saving alone won't do it. Investing alone won't do it. You need income growth, disciplined investing, smart tax planning, and asset ownership working together at the same time. Wealth multiplies when strategies overlap. One of the most powerful accelerators is ownership. Employees earn income. Owners build wealth. That doesn't mean you must quit your job tomorrow. It means you should begin thinking like an owner. Owning stocks means owning pieces of businesses. Owning real estate means owning income-producing assets. Owning a side business means owning cash flow. The shift from consumer to owner changes everything. Every dollar you direct toward ownership increases your long-term leverage. If real estate fits your risk tolerance and financial situation, it can be a strong late-start wealth builder. Rental properties can create both appreciation and monthly cash flow. House hacking, living in one part of a property while renting out another, can reduce housing costs dramatically. Real estate also offers tax advantages like depreciation and expense deductions. However, it requires research, patience, and cash reserves. It's not passive in the beginning, but over time it can become a powerful engine. Another path is building scalable income. Unlike hourly wages, scalable income is not directly tied to time. This could be digital products, consulting packages, content creation, licensing intellectual property, or equity in a growing business. Even if you start small, scalable income creates upside without proportionally increasing your hours. When you're starting late, leverage over time is critical. Let's talk about risk management as you build. As your net worth grows, so should your protection strategy. Diversification isn't just a buzzword, it's survival. Avoid putting all your capital into one company, one property, or one idea. Markets change, industries shift. Diversification protects progress. The goal is not maximum risk, the goal is optimized risk, enough to grow, not enough to collapse you. Healthcare planning also becomes more important for late starters, especially in the United States. Health savings accounts, HSAs, can be powerful because they offer triple tax advantages: tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. Used strategically, they can even function as supplemental retirement accounts. Another powerful mindset shift is thinking in decades, not months. Many people underestimate what focused investing can accomplish in 15 years. With high savings rates and disciplined contributions, even a late starter can build substantial wealth within 1 or 2 decades. But impatience kills progress. The market rewards those who stay consistent during volatility. Let's also address social pressure. When you start building wealth seriously, you may need to say no more often. No to unnecessary upgrades. No to lifestyle inflation. No to keeping up with friends. Financial independence requires temporary discomfort, but that discomfort buys permanent flexibility later. Every disciplined choice today compounds into options tomorrow. And here's something powerful. Your peak earning years may actually be ahead of you. Many professionals earn the most in their 40s and 50s. That means your highest investing capacity might still be coming. If you combine peak income years with aggressive investing, you can compress decades of growth into a shorter window. Most importantly, track your progress. Measure net worth quarterly. Monitor savings rate. Review investment allocation annually.
When you track numbers, you stay focused. What gets measured improves. Watching your net worth rise creates motivation. It turns wealth building from an abstract dream into a visible scoreboard. In the end, building wealth after starting late isn't about regret, it's about responsibility. It's about deciding that the next 10 to 20 years will be intentional. It's about turning discipline into freedom. You cannot change when you started, but you can absolutely control how intensely you move forward now. And if you commit fully, increasing income, investing aggressively, protecting assets, and staying consistent, you won't just catch up. You'll build something strong, stable, and truly yours. Now let's bring everything together. Building wealth late is not about speed alone. It's about precision. Every dollar must have a purpose. Every investment must align with your long-term plan. Every financial decision must move you closer to independence. When time is shorter, clarity becomes your greatest advantage. You don't have the luxury of drifting. You must operate with intention. At this stage, automation becomes your silent partner. Automate investments, automate savings, automate retirement contributions. Remove emotion from the equation. The more decisions you automate, the less likely you are to sabotage your own progress during market downturns or moments of fear. Wealth is built by systems, not moods. Another critical piece is defining what enough actually means. Many people chase wealth without knowing their target. Calculate your annual living expenses. Multiply it by 25 if you're using a conservative 4% withdrawal framework. That number becomes your financial independence target. Suddenly, the goal becomes measurable. It's no longer, I want to be rich. It becomes, I need X dollars invested to generate Y per year. Clarity removes anxiety. Let's also talk about legacy. Starting late often means you're more aware of family responsibilities. Estate planning is not only for the ultra-wealthy. Having a will, proper beneficiaries listed on retirement accounts, and possibly a trust ensures what you build transfers smoothly. Wealth is not just about consumption, it's about continuity. Even moderate wealth, handled wisely, can change the trajectory of the next generation. And here's something powerful. Wealth building is not purely mathematical, it's behavioral. The biggest threat isn't market crashes, it's inconsistency, it's panic selling, it's giving up after one bad year. Markets will fluctuate, real estate will cool off at times, business income may dip, but if your strategy is sound and diversified, temporary volatility is not failure, it's part of the process. You also need to protect your energy. Burnout is real, especially when you're pushing aggressively to build wealth later in life. Remember, this is a season of focus, not a lifetime of exhaustion. Schedule rest, protect relationships. Health is wealth. There's no point in reaching financial freedom if your physical or mental health collapses in the process. One of the greatest advantages of starting late is emotional maturity. You're less likely to fall for hype. You're more likely to value stability. You understand consequences. That maturity, when combined with disciplined financial action, becomes a competitive edge. While others chase trends, you build foundations. As you approach your target, begin shifting from accumulation to preservation. Reduce unnecessary risk gradually. Strengthen income stability. Focus on sustainable withdrawal strategies rather than maximum growth. Wealth building has phases: aggressive growth, optimization, and then protection. Recognizing when to transition between these phases is key. And remember this, the goal is freedom. Freedom to choose meaningful work. Freedom to spend time with family. Freedom from financial anxiety. Wealth is not the money itself, it's the control it gives you over your time and decisions. If you're starting late, here's the truth. You are not behind. You are experienced. You are aware. You are capable of focused action. The next 10 to 20 years can completely redefine your financial future, but only if you decide today that average is no longer acceptable. Start now. Increase income. Invest aggressively but intelligently. Eliminate high-interest debt. Protect what you build. Stay consistent through volatility. Measure progress. Adjust strategically. And most importantly, never let regret steal your momentum. Because wealth doesn't ask when you started, it only responds to what you do next.